Bernanke holds a press conference and strikes back at the GOP. So, is QE3 in our future? I'm Allen Barton. Stand by for Front Page.
The concerns that have been expressed relate to the possibility that the Fed's highly expansionary policies might be contributing to inflation risk. I would simply point to the record. If you look back for the last 5 years, inflation, although it's been volatile because of commodity price fluctuations, has averaged about 2%, which is close to a reasonable definition of price stability, whereas the area where we have fallen short, obviously, is on the unemployment side. So I think that criticisms based on the concern about inflation have so far at least not proved to be very valid.
All right, joining me is Agustino Fontevecchia of Forbes.com. Agustino, thanks for being here.
Hi, always a pleasure.
Now, you recently wrote that the GOP has been focusing their Fed policy attacks sort of on inflation rather than employment. Why don't you elaborate on that in relation to what Bernanke is saying there?
Well, the thing is that the Federal Reserve, the criticism of the GOP is kind of based on either not understanding or not accepting what the Fed is supposed to be. So the Fed is supposed to be an independent body that targets full employment and price stability. So in other words, that means they want the unemployment rate to be as low as possible, and they want inflation to be at 2% or a little bit less. So when the GOP came out and tried to tell Bernanke, yo, don't do any more quantitative easing, no more expansionary monetary policy, stop debasing the currency and stop causing more inflation, Bernanke snapped back at him saying, like, look at this, inflation has been under control. We've actually managed it quite well, and it was actually being caused by external factors more than anything, energy and food costs, which had gone up quite a lot. So Bernanke indirectly, because he never mentions them, even though he was responding to a question about the Republican letter, tells them, listen, guys, you should hone in your criticism on the right side of the coin, which is, the job growth, not the inflation part of the question.
And what do you think? Do you think he's got a point there in terms of that inflation has been under control during this period of expansion? And what do you think about what they should be doing, if anything, to try to foster full employment?
Well, so there's a few things. Bernanke was smart enough that after he said that, he came out and he said that he would like a little help from other parts of government in stimulating job growth. So in other words, he told Obama, Democrats and Republicans, he told everybody on the other side to do something about stimulating the economy or helping the housing market or any sort of policies from their side, because what the Fed has done is quite big. The Fed has done a lot. So it's actually not the Fed's role, and it's not really monetary policy's role to stimulate aggregate demand beyond interest rates. I don't want to get way too technical, but in other words, their main tool is using interest rates to make sure that there's greater loan accessibility and that people rather spend instead of saving. They've done that to a very extreme point where interest rates are zero, and they're using quote unorthodox methods to try to lower long-term interest rates. So the Fed has done a lot. Now, quantitative easing always helps a little bit because it boosts the markets. It doesn't fully boost job creation as much because it's kind of a blunt weapon in that side. So I would say that Bernanke is right in asking Congress and Obama, Democrats and Republicans to do more. And I think that they have done quite a lot from the monetary side, from the Federal Reserve side, to try to get this happening.
Well, do you think that if a QE3 is coming down the road, that'll be effective? It doesn't seem as though one or two have done much, unless you make that argument that Obama has made of, like, jobs saved, the jobs saved logic, where, well, imagine if they hadn't done everything they've been doing.
Right. So I haven't really read too much research. There's not too much out there about the exact impact of the other the QEs. Now, I remember Bernanke saying that QE2 either saved 600,000 jobs. So that's a pretty substantial number. It's not that huge. We just had 80,000 jobs created last month. So 600,000 is a pretty good number. Now, the thing about QEs, what it does is it inflates asset prices. So Bernanke believes that you can spark a so-called wealth effect. So there's a virtuous cycle when asset prices go up, companies begin to hire more, wages are growing, and people begin to buy. That's what he's trying to create. Now, it's not happening because households are deleveraging, because they're saving, because they're uncertain about what's going to happen in the future, and at the same time, as the crisis kind of brewed and created and occurred, houses were over-leveraged. So it's turning out to be a lot harder to create and make people spend. So I believe that it will have some sort of effect. It will definitely have more of an effect on pumping balance sheets and companies than helping out households. And I think that Bernanke was right in saying that it's housing that is kind of holding down the recovery. And you know, the Fed has done a lot to keep mortgage rates at record low. Now, banks are not lending because also they're afraid about what's going to happen in the near future. About QE, I believe QE3 is coming, and I'm basing this off Goldman Sachs head economist Jan Hatzius. He explained that GDP is going to slow to probably around something like 0.5%. I believe he said in the first quarter or the first half of 2012. When that happens, you're going to see inflation kind of move toward the deflation side. And when asset prices begin to fall, Bernanke is going to come in and you know, pump the economy up in that sense. So it seems like twist, which is what's going on now in the Fed, which is this twisting of the maturities towards longer, twisting their balance sheet towards longer term maturities, is going to give way to some sort of asset purchases or quantitative easing.
Finally, since you're there in New York, what has your impression been of the Occupy Wall Street movement? Have you been down there at Zuccotti Park or what?
Well, I'll tell you a story. I was actually walking around the West Village and I saw this random mob of people kind of taking the street a week ago. So I had a camera with me, so I followed them. I took a bunch of cameras. I'll tell you one thing. I do understand the concern, and I believe that it is appropriate to say that in a economic system, a financial system that is based on the financial sector, where it's justified that bankers make so much money because they're supposed to be the most efficient allocators of capital. The fact that they have not been the most efficient allocators of capital, and the fact that the richest people, the top quintile of the population, has made a lot more money than the other quintiles of the population in relation to GDP growth, says that there is something that's right about the Occupy Wall Street movement. So I do agree that income inequality has, you know, it is a problem that is there and it has to be approached. Now, I don't agree with them in a couple of things. When I was walking with them, they, for example, at one point started saying, we're the proletariat. And you got to read Marx before you can mention the proletariat. And even though I'm assuming a lot of them have read Marx, this has nothing to do with communism and Marxism. It has to do with other things because these people are clearly capitalists. So I agree with their overall message. I think that some parts of the movement might not be very clear on what that message is. I don't think necessarily they have to be, but I agree that income inequality is a problem out there.
All right, Agustino, thanks for being with us. Interesting as always. You can find more of Agustino's work by going to Forbes.com. Joining me in the studio, Don Watkins, analyst for the Ayn Rand Center for Individual Rights, and Terry Jones, associate editor for Investors Business Daily. All right, Terry, going back to Bernanke and the Fed, what do you think of what Agustino's opinion is there about inflation factually not demonstrating a big rise, and so Bernanke's going to continue to work on employment, and that we might be facing even a deflationary emphasis, which would prompt another QE.
Yeah, I really disagree with him. You know, we've already spent $1.7 trillion on quantitative easing 1 and quantitative easing 2. Quantitative easing 3 would just be more of the same. It hasn't done anything. The claims that it's saved 600,000 jobs are laughable. It's a farcical claim. All it's done really is
unverifiable.
Unverifiable.
It's proving a negative of something that doesn't exist. You know,
you can't count the jobs, and the problem we have is that this amount of money printing really is doing nothing other than supporting the government's printing of debt. It has nothing to do with the private sector of the economy. It's really supporting the Treasury in making sure that we can run deficits of $1.5 trillion a year. It's a complete flim-flam, in my opinion. And I think it's going to be very sad because we've really distorted markets by all this money printing, and that's why we have so much volatility in the commodities market and the stock market.
Don, what do you think of what's going on here? I mean, what's Bernanke talking about in the sense of the fact that there hasn't been a measurable inflation, you know, except in energy and commodities, or which are things that the average American household deals with a lot. So, do you see, was there hypocrisy there, or does he have a point?
Well, part of the confusion is that inflation technically means just an expansion in the quantity of money at a faster rate than the rate of the increase in gold. But yet we usually talk about inflation in terms of price inflation, which is the actual prices that we pay for the goods and services that we buy going up. And the real issue is that when the Fed starts dumping money, printing money and pouring it into the economy, that has destructive effects whether or not it immediately raises prices on groceries or prices on, they exclude groceries, so prices on all the other sorts of things we buy. So there's a technical way in which he could say we're right, which is by the standards by which we measure inflation, we haven't had inflation. But the standards are all wrong. And the fact is that what we're ultimately going to see, I think, is exactly what Terry's talked about.
All right, gentlemen, good discussion. For Agustino, Don, and Terry, I'm Allen Barton. Thanks for watching Front Page.